Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The Economic Offences Wing of the Delhi Police arrested former Fortis promoter Shivinder Singh and 3 other associates on charges of siphoning funds from Religare Finvest. TCS profit and margins fall to a 9-quarter low despite a weak rupee and lower visa costs. Infosys will report its earnings today. Chinese President Xi Jinping will arrive in Mahabalipuram in Tamil Nadu today for a 2-day informal summit with Prime Minister Narendra Modi. The Polish author Olga and Austria's Peter Handke will win or rather have won Nobel Prizes in literature. Well, let's take a look at the trade setup for the day. The US markets ended well, primarily because in a White House address, Donald Trump spoke fairly optimistically about the trade talks. He mentioned that I think it's going really well, quote unquote, of course, quote right now. I think it's going really well. I will say, I think it's going really well. We had a very, very good negotiation with China. They'll be speaking a little bit later, but they are basically wrapping it up and we are going to see them tomorrow right here. This was Donald Trump. To a press conference, and of course on Twitter, of course, he put out saying that big day of negotiations with China. They want to make a deal, but do I? He will meet with the vice premier tomorrow at the White House. So he was at it and the US markets were at it too. So amidst conflicting signals the previous 2 days and the volatility thereof, we had some clear signals, at least from the looks of it. And therefore, the US markets did reasonably okay for themselves. It's showing off a little bit on the world markets with the kind of moves that Nikkei, Hang Seng and Shanghai are making. The SGX Nifty too showing some uptick in the session today. Let's see if that materializes into green on open and during the course of the day. But it's very volatile for our markets as well, right? Sometimes you would probably believe that the Indian markets right now are a lot more volatile than what almost any of the other major world markets would be doing, including the US. Wednesday was a big day of gain, 1100 points, and yesterday the Bank Nifty gave up almost 900 points or nearly 900 points out of that 1100 point gain or on Wednesday. So that's the key thing that you got to monitor. What also I think, while Bank Nifty will do what it does, what also I think will remain a key overhang could be Nifty IT. TCS results haven't quite inspired, and we have well seen Nifty IT, which is a fair degree heavyweight on the Nifty as well, remain a bit of an overhang. The only support I reckon that would come in is that we are at key support levels from where we have shown some bit of a bounce, and with the global markets looking benign, we might just get some support for the intraday bulls. So that is something that you got to monitor in the session today. Do we show some bounce backs from where we are currently? The major result today on the Nifty would be Infosys. Of course, will come out post-market hours, but something that the street would be watching out for. And after TCS's relative disappointment, can Infosys kind of nullify or blunt that negativity? Let's wait and watch what happens there. I mean, there's ITI, Bajaj Consumer Care, Den Networks, a few stocks that got to monitor from a results perspective. But all of these still not big enough to drive their earnings conversation, save for what TCS and Infosys have done. Speaking of TCS, that to my mind remains the biggest stock to monitor in the session today. Operating margins fell to the lowest level in 9 quarters. And remember, operationally and otherwise, results have disappointed. Top line, both on the dollar and rupee terms, was below estimates. It was anyways expected to be a quarter of operations, but there has been disappointment out there. Management has said it will be hard to see double-digit growth in FY20. So lots of disappointments, and I think we'll put that into perspective on first word. So I won't dwell too much on it, but for the fact, I firmly believe that we might see a negative reaction on TCS today despite the dividend. GM Breweries, revenues are up 8.6%. Margins have completely collapsed at 20% versus 27.2%. The higher raw material costs have dented margins for the company. Now remember, in the past, typically this is first off the block, and it's had an impact on some of the other companies as well. I doubt this time around could be the same, but maybe the markets would like to believe that some extrapolation on operational numbers for the other liquor companies. So let's wait and watch what happens to that entire pack. Tata Steel updates have come out I don't know if there's anything too dramatic, but global markets and commodity prices commodity stocks are all doing okay. So never mind what's happened here. And these updates are out, yes, and there's some volatility there, but maybe the steel stocks could have a decent outing today. We will watch out for Bharat Forge, the analyst meet. They have sounded some fairly cautious tones on almost all business verticals. Maybe the stock corrects a bit. However, let's tell you what's lined up on First Word today. It's a collection of the top editorial stories that we want to bring to you. Sajid Mangat first joins in to tell us why the margin of TCS fell to a 9-quarter low, while Agam will tell us what is expected from Infosys. Then Charlene D'Souza will bring us the findings from BloombergQuint survey of FMCG distributors. Nikki Mirchandani will then join in to explain just how sensitive Indian aluminum producers are to global prices. And finally, Sumit Sarkar will wrap up the First Word today by telling us about India's most expensive stocks. Not been the best start to the earnings season for the Indian IT space. The country's largest outsourcer, TCS, reported the lowest margins in 9 quarters at a time when the rupee depreciated and it's had to spend less on visas. Sajid Mangat was there at the press conference as well, Johnson, to tell us why. Sajid, the numbers and the body language, both.
The numbers were not as per street expectation because Q2 was supposed to be a better quarter, and the second half was supposed to be a slower, sluggish quarter because you have furloughs in Q3 and Q4. That would have meant that the revenue growth would have been slower. Now, what has happened is that in the first half, they have grown the revenues by 8.5% or so. That's much lower than the street expectation because TCS from the beginning has been guiding about double-digit growth, and this was pegged on squarely on the BFSI space. We saw BFSI picking up in Q3 of last financial year, Q4 and Q1, and suddenly we've seen a drop in BFSI again, and the reason being there's some amount of uncertainty which is happening at the top tier level of financial banks, which is in Europe and UK because of the Brexit which is happening there, and in Wall Street banks as well at the top tier. So that's what TCS is talking about, saying that while we see growth happening in the mid banks, where they're going for automation and they're going for transformation technologies, there is a hold up which is happening at the top tier banks, and those are the ones which are big revenue generators for the IT major there. Another thing which is very important is, though they have been clocking a TCV, which is a total contract value of more than $5 billion every quarter, and last quarter has been the biggest one with more than $6 billion, they've not been able to convert them into revenues. And there is a slowdown which is happening in that. So you're signing a contract, but the revenues are not kicking in because and it's not like a traditional IT business where you need to put up a hardware. So your first quarter would be only setting up hardware, so you don't get much revenues coming in, and then the revenues start kicking in from second, third quarter. That used to be the earlier model. In digital, it's not the case. It's basically hierarchy going through the value chain to the core, and putting all the system place. So the revenue should have kicked in, and it's not happening because there is a slowdown in the way banks or its customers are also going through this. So they're signing digital contracts, but they're trying to figure out how to do it, how to get the architecture in place. It could be that's the reason why there's a slowdown in conversion. So high TCV, but it's not converting into good revenue stream for them. Margin is another issue which we've been talking about. They've been talking about aspirational margins of about 25%, but we saw a 9-quarter low margin coming in this quarter, 24% for TCS. And I did ask them whether this is a bottoming out of margins coming in for you. They were not so committal on it, though they are saying that they're going to keep on investing on manpower and capacity because they have a huge order book which they had to fill. But considering that they're not able to convert many of the projects, it seems that the margins could reach 24% going forward. So that's going to be a thing. And also the fact is this space is getting very competitive. We've seen Infosys taking away a good chunk of big deals from the market. there's a price competition which is happening, so will have an impact on margin at some point in time, and that's maybe playing out or is a start of playing out which is happening. So we should look at whether there is a strata shift of margins for IT companies, especially TCS, as it goes into digital, and as digital also becomes a commodity. So those things will need to be looked at very carefully there. The third or fourth point which I want to discuss is the retail push back which is happening. Retail has been a slow for some of the TCS clients, and they are very big in retail, but they're seeing a pushback of orders coming in. So companies are not giving them orders, or they are in the pipeline but they're not getting signed. These are some of the uncertainties which is there, which was not visible now. And if I use the words which they said, they don't have visibility on these kind of deals which is coming in.
So which was going to be my question, Sajid. Between the last 2 or 3 quarters and what they spoke yesterday, was there a distinct shift in the body language and the commentary from the management as far as the outlook goes?
Yes, there was a body language shift. There is a commentary shift, because they don't know how to explain this slowdown. I mean, I couldn't figure out where this slowdown is coming from for a company which is getting a revenue of more than $5 billion in TCV every year, and last quarter happens to be $6 billion, and you're not able to convert it. So you're creating an order book but not converting into revenues. Why is that not happening? They're not able to give me a convincing answer to it, except for the fact that it takes time. It shouldn't take time for a digital thing, and 33% of the revenues today come from digitals, and most of the new orders are coming from digital and BFSI. So my understanding is that even though they're signing the deal, the start date is getting pushed.
Yeah.
Some way, or companies are pushing the start date, saying that okay, we want to move towards it, but we don't want to do it now, maybe next year. So we will push it in the discussion so that the revenue doesn't kick in. It could be that as well, which is happening. So these are the factors which are playing out. We need to see what kind of commentary which Infosys is going to do, because they've been also bagging a lot of deals in the last couple of quarters. And if you look at analysts, how they've been talking about, while analysts were focusing on double-digit growth for TCS, now that's not going to happen. They're going to see normal 8.5% growth this year, but that too on a big base. So you have to give to them. But I think they're more bullish on Infosys now, because their execution has started happening now. Yeah,
well, let's see. Infosys needs to deliver big time today as well, so that is something that we will monitor, of course. Keep in mind, viewers, they've added a bit of a sweetener. TCS has the dividend. It's probably the highest in the last 5 years, one-time single dividend. But let's wait and watch. And the whole piece around what brokerages said about TCS would be there on the website. If not now, then very, very shortly. So do log on to BloombergQuint.com. Sajid, thanks so much for putting that into perspective. Well, TCS may have missed the mark, but will Infosys manage to spring a positive surprise? Agam Vakil is here with the expectations.
Well, it's going to be another quiet quarter for Infosys. In terms of expectations, what we are looking at is around 2.8% uptick as far as revenues go sequentially. Revenues likely to rise 3.7% in rupee terms, and we are expecting a 100 basis points expansion in EBIT margins at around 21.5%. We are likely to see profits rise 6.5% to around 4,045 crores. Now, we do see steady revenue growth, and that will be largely on ramp up in deals that the management has spoken about in the previous few quarters. As far as guidance is concerned, there are at least 3 brokerages who are expecting the company to up their guidance. As far as UBS and Kotak Institutional are expecting the Infosys to increase their guidance to around 9.5% to 10.5% in constant currency growth. And as far as Prabhudas Lilladher is concerned, they're likely to see an uptick of around 9%. That is the lower end of the guidance. The current guidance, of course, stands at around 8.5% to 10%. Operating margins are also expected to expand. Why? Because of wage hikes which have been absorbed in the first quarter, rupee depreciation against against the US dollar, and of course seasonal moderation on account of lower visa costs. However, what we will be keeping an eye on is the company's commentary on BFSI vertical, as well as the state of the economy in the US as well as Europe. We're also keeping an eye on the total contract value, pipeline momentum, and benefits in margins, if at all, on the back of localization efforts. But on the whole, not expecting any fireworks as far as Infosys is concerned.
Well, let's see. And that was about IT, but what about consumer staples? Remember, Hindustan Unilever comes out with its numbers on Monday. Well, a BloombergQuint survey conducted amongst 9 distributors spread across 8 states doesn't paint a very rosy picture. Charlene D'Souza is here with the findings of the survey. Charlene, good morning.
Good morning. So demand for consumer goods failed to pick up in the July to September quarter, despite orders already coming in to distributors due to the onset of the festive seasons. Now sales largely remained unchanged during the period, and volumes were between negative to flat. And also the credit days went up. That is the payment from the retailer to the distributor. The number of days that they usually get the payments have gone up. In some cases, it's gone up over a month and to 45 days. Now the issues remain common across states. Now distributors are saying that volumes continue to remain under pressure, and so now let's go across the country and see what has happened across different states. Now in Maharashtra, demand growth remained under pressure while credit days remained high. In Mumbai, growth was in low single digits. In Goa, sales continued to be under pressure, and also the number of credit days continued to remain high. Rather, it was over a month. Some were saying it was even crossing over 2 months. Now, in Telangana, demand continued to remain stagnant while credit period went over a month. In Punjab, demand continued to stay under pressure while credit period ranged between 21 to 45 days. Now in West Bengal, festivities in the state failed to revive demand for consumer goods, while inventory carrying days, that is the number of days that the distributor is sitting on inventory, has gone over 15 days. In Uttarakhand, the distributor said that it is the worst quarter they've seen in the last 1 year, and the credit period is for over a month. In Delhi NCR, it's single digit demand growth that they've seen, rather low single-digit demand growth. In Orissa, they've seen the negative volume growth, but value growth remains stagnant or flat.
Okay. So, as I understand this correctly, Charlene, double problem. One, that demand is anyways lackluster, and the distributor is hit from his customer as well, because the credit period has moved up quite substantially.
Yes, the credit period, as in the payments that take, because what they are saying is that the retailers are actually, since demand is not picking up at the consumer level, and retailers are finding it difficult to make payments. So the number of credit days that are constantly increasing, and also the other issue that has come up at the retail end is the emergence and of modern trade actually expanding, and retailers themselves going and shopping at modern trade outlets instead of shopping from the distributor. That has emerged. Consumers are also going to modern trade outlets. This is especially picking up in tier 2 cities where modern trade is actually expanding at this point in time.
So there is an outside chance that while the distributors have not seen double-digit volume growth,
yes,
because the modern trade channel would have picked up, 1 or 2 or 3 companies which could have some strengths there might actually outperform.
Yeah, but we also need to understand that modern trade still for a company like HUL is around 10-15%, and also what we need to understand that the general trade is 90% of the overall trade in the country, while modern trade is only 10% for the sale of FMCG goods. So this does remain a very important channel. Even if this changes over a period of time, it's going to take some time till modern trade actually penetrates.
Yeah, so I'm glad we put all of this into perspective. 90% of the channel for almost all FMCG companies is still seeing stress, and maybe modern trade has picked up, but that doesn't contribute that meaningfully.
Yeah, so what Marico has said, that e-commerce and modern trade have continued to stay on course, but general trade, that is rural and urban, were under stress during the quarter.
Well, let's see if the management of HUL paints a slightly more rosy picture for the quarters ahead, if not the quarter gone by. Charlene, but a very interesting survey. Thanks so much for bringing this to us. And of course, as I say, almost all of the pieces would be there on our website, BloombergQuint.com. So do try and log in and try and read more about some or all of these. Metals and aluminum prices fell to their lowest in 3 years amid trade tensions between the US and China. The falling demand from automobile sector only made things worse. But how much will this affect Indian producers? Nikhil Mirchadani standing by with some analysis out here. Morning, Nikki.
Morning, Neeraj. Trade tensions along with the global headwinds, they've zapped out the entire industrial complex space. LME aluminium is no exception to that. The prices are at 3-year low. But then what's really worrying at this point of time is the changing dynamics of the industry as a whole. And also what contributes to the drop is the falling raw material prices. So that's two factors that's actually played out behind the low level of aluminium right now. Let's look at why the dynamics have been changing. Kotak Securities report suggests that we're looking at a deficit situation coming in, the surplus situation coming in 2020 as compared to a deficit that the industry as a whole is witnessing. They have estimated a surplus of 0.4 MT as compared to a deficit of nearly 0.3 MT in 2019, on account of which they've also slashed aluminium prices by 4 to 5%. What has led to the change in forecast for the industry is the capacity additions right now which are happening in China. We're looking at a 4 MTPA capacity addition coming in till 2021 from 2019. So that's one bit. In a situation when the demand is lower, or rather the aluminium producers, the world largest aluminium producers going ahead and cutting that demand forecast, in a situation like that, if you're adding capacity, that definitely doesn't augur well for the industry as a whole, along with the pricing power. If you look at the demand situation out there, it's only recently that Rizal in the Q2 presentation suggested that it's looking at a demand forecast of around 1.25% to 2.5%. From the earlier estimates of 2.5 to 3.5%, so there is clearly a trim down in the forecast out there. Also, we all know how the automotive sector as a whole is doing. Globally, automobile production has fallen by 7% in the first half of this year as compared to what we've seen in the same period. Also, if you talk about the raw material prices, it's a simple logic. It just moves along the value chain. If you see a reduction coming in on the raw material prices, you will also see that downward pressure being reflected in the finished products. That's the case right now with aluminium, because alumina prices, they've fallen by as much as 20% or 22% right from June that we've seen, because of which we might just look at some downward pressure coming in on the aluminium prices. How does that impact the domestic producers? Because the prices here are a link to the global prices. If you see some amount of cheapness coming in the global prices, there definitely is going to be more imports. In fact, NALCO in the annual report has suggested that 50 to 60% of the consumption was actually coming in from imports. So clearly there is a threat out there. Let's look at the sensitivity analysis of how does that price affect the EPS of the companies. The highest is for NALCO, because it's an integrated producer producing both alumina as well as aluminium. So there you have a big 12% sensitivity to 1% change that you see in LME prices. Hindalco is next at 2.5%, and Vedanta, since we all know it's diversified and aluminium is only part of its big portfolio, that's why the impact is relatively a little lower.
Okay. Thanks so much for that, Nikki. Just very quickly, a small follow-up. For Tata Steel, the updates that have come in, anything that stood out?
No, it's pretty much in line with what the street was estimating. So I don't see any kind of standout performance, or dismal performance rather, coming in from Tata Steel this time around.
Great, Nikki. Thanks so much for putting that into perspective. Well, from moving on from metals to the last piece on First Word, even amidst the current market correction, there are some stocks that are trading at significant premium. You would say it always happens, but it's always great to know. Now, Samit Sarkar, what he's done is standing by with a list this time around of India's most expensive stocks. And Samit, some of these valuations took even me by surprise. I mean, I've watched these markets now for 16, 17 years, but some of these valuations were just startlingly high.
Yes, I'll start off with the selection criteria first, because that is more important
Sure.
to know how we have got the stock. So firstly, we have selected stocks with more than 10 analyst ratings, and that we have listed on the top 5 stocks with highest 12-month forward price to earnings multiple, excluding the companies belonging to the banking and the NBFC space. So the top of the list is Avenue Supermarts. Now the share prices have run up nearly 40% in the last 1 year, making it one of the most expensive stock in India. Now this rally in the share price could be attributable to the 30% plus revenue growth and 19% net profit growth reported by the company in every quarter in the last 1 year. Along with this, the low public float that Avenue Supermart has also could be one of the reason behind this up move in the share prices. Second on the list is Trend. Now, the street has been bullish on the stock on the back of its highest ever new store additions, strong operating metrics, and large fundraise, of which most of which will come through from the promoters. Along with this, also reduced losses in the Star Bazaar has kept the street bullish. Now, despite this high valuations for Trend, nearly 10 out of 13 analysts tracking the company have a buy rating, and the return potential on the stock was still positive 2%. Third on the list is HDFC Life. Now, for that company's strong performance of credit product business despite macro headwinds, superior value of new business margin coupled with continued demand for its Sanchay Plus product has led to this 57% rally in HDFC Life's share prices in the last 1 year. Now, for Nestle India, it was faster growth than peers in the first half of calendar year 2019 and 2018 has kept its valuations elevated. Now, this strong volume growth by Nestle was aided by its differentiated distribution strategy, more product launches, aggressive advertising spends, and fresh capital expenditure that the company has been doing. Last on the list is Godrej Properties. Now, with gains of over 50%, Godrej Properties is the highest gainer in the Nifty Realty Index. Now, these gains were mainly on the back of consolidation that we have seen among the cash-starved small and medium players, which led to market share gains for Godrej Properties. Along with this, growth in its joint development portfolio and a strong brand has also aided this rally for Godrej Properties. And to know about the other 5 stocks that are there in the top 10 list, and to know the expensive stocks from the banking and the financial space, do log into BloombergQuint website and get in more details for the same.
Well, some of those numbers are pretty astounding, and yes, do log onto the website and try and read more about this. Sumit, thanks so much for putting that into perspective. Some of the most expensive stocks in India. That's all that we have on First Word today. Lots more lined up on Indian Open, though. We discuss markets, macros, earnings, and more with Nishchal Maheshwari of Centrum Broking. Important market guest to have today. The regulatory hurdles faced by Indian drug makers with Amit Rajan of Prosphora Technologies. And then CRISIL expecting corporate India's revenues to fall to 14-quarter lows in Q2. The director of CRISIL Research, Hetal Gandhi, joins in a bit later on. After this break, a full tilt towards the day's trade.